Hello, and thank you for joining us for the latest in our series of Dolfin discussions. Today we're going to be having a conversation with two of my colleagues, Geoff and Androsiuk. We will be looking at the bond ETF market, which has become of great importance as of late. And there are, I think, a few questions that have been raised as to how it functions and what its role is going to play in the weeks and months ahead. So let's start things off with just an overview of what's been going on in the fixed income markets. Geoff, if you don't mind, if you could just catch us up with what's been going on in the past couple of weeks.
Yeah, so after a very tough month in March, where we saw significant declines across the risk assets, in April, we've actually had a pretty solid and positive month. Sure, we've felt some of the aftershocks with the oil price crash, but volatility has come down, liquidity has improved, and we've seen a retracement in the market. And that's mostly been driven by Fed intervention and the ECB bid as well through its pandemic emergency purchase program. So significant flows back into US high yield. Primary markets have come alive. We've already seen some 34 billion US high yield issuance this month. And it's not just those frequent benchmark issuers. We've got directly impacted sectors, such as theme parks with Six Flags, we've got Hilton Hotels, and also Wynn Casino. The latter, which saw lenders agree to lift debt incurrence limits and replace it with liquidity maintenance covenants in order to allow a deal to go through. So we've seen very strong recovery in investor sentiment and also issuer behavior. And we'll be speaking more about this in our monthly investment update next month. So please tune in for that for more on our fixed income positioning, as well as what we have to say in equity markets too.
Absolutely, thank you for that. Interesting. So the fixed income markets seem to have responded very positively to a lot of the Fed rhetoric and action that's been coming out. Well, not just from the Fed, from central banks generally. Carl, could you maybe comment a little bit on what you've been seeing with liquidity, with depth, with trading costs? Because I know that one of the issues that the Fed in particular was extremely worried about was sort of a seizure in the financial markets and the bond markets. What have you seen on your side?
Yeah, it's an excellent question. We saw a lot of clients looking at names like Geoff mentioned, some of the more distressed names that have been suffering. And if you were trying to get out of that position in March, it was pretty hard because spreads were excessive across the board, but very, very wide on some of those troubled names. As a general rule, I was looking back at some of the spreads before we come on this call, and you would get an IG, which is almost usually basis points wide, going 10, 20, 30, 40 basis points wide in March. And as it's come down as Geoff said, April's getting better, it's come down to probably about half that level, not quite where it was. And it's the same is true for the high yield and also some of the more distressed names that were out there. As a result, that was filtering down to not only the clients who were generally no panic or anything, but just keen to exit some positions. And generally speaking, if you were trading liquid product, it was fine. The spreads were a bit wider, but nothing crazy. As now, they're a little bit tighter. And I should say, as we're talking about bond ETFs and everything, those spreads in the underlyings directly correlate to the spreads that the ETFs were showing. So we were executing a few bond ETFs and we were seeing wider spreads towards the end of March compared to February. Right now, they're pretty much back to where they were, and they're much tighter, reflective of where the underlying bonds are actually trading at the moment.
Okay, you've brought up bond ETFs. Fantastic. Let's go there then. Can you really quickly walk us through, Carl, sort of the mechanics of a bond ETF, and maybe touch a little bit on the pros and cons? Because I mean, you've already gone into liquidity and spreads, bid-ask spreads, and that's one of the questions that I'm gonna hit you with once we've got a better sense of what we're talking about here with the bond ETFs, is how it all functions. So just start with how they work.
Yeah, very, very simply, most bond ETFs will track some type of index issued by one of the major issuers, let's just say Bloomberg or Barclays, and effectively their primary goal is to track that ETF. What helps is because it's an ETF and it's listed on an exchange somewhere, let's just say London, for example, you have an array of market makers and authorized participants who are basically showing prices in that bond. as such, I want to call it outsourced liquidity. You as a user of the bond go and say, I want to buy 1,000 shares, and you get competing people offering you a price. Their price is a function of the underlying market. So with bond ETFs, it's about buying and selling the bonds for you. The great thing about ETFs is you can add layers of liquidity from the point of view that you're a little person, and some of these bonds are very big. So you're gaining access to some of the institutional liquidity if you're a retail end of the spectrum. You can also add some currency hedging if you want there. And there's also a cost element. As you said, you're basically paying somebody else to do the work for you. So that includes buying the bonds en masse, managing the index, managing the bonds underneath the ETFs, and also managing roll-offs. So natural expiries, new issues like Geoff mentioned, new issues are really hot at the moment. All that stuff is done for you, and for that you pay the ETF effectively a price for that.
But presumably there's a lot more volume going through on the ETF, or the trading on the ETF is a lot more high frequency than you would expect in pricing of the underlying name. So is there a price discovery issue here? I mean, are ETFs in some way sort of getting in between the market and the underlying names, and maybe perhaps muddying or mitigating the price discovery that you might normally find with those underlying names?
Yeah, I think for some of the smaller ETFs, especially in the bond world that are more specific on a region, you're exactly right. They can skew the market a little bit because obviously they're out there trying to hedge themselves. At the end of the day, if you buy an ETF and everybody else is buying it, then the person who's supplying that to you is kind of out there in the market buying all these bonds, and that can have an undue effect if the market's not particularly deep, or if the spreads are quite wide, because you end up having people buying and selling and getting a bit active. That's probably what happened in March, and that's why a lot of the ETF market makers basically just said, I tell you what, it's a bit complicated right now, a bit hard to hedge. We're just going to make our spreads a little bit wider. But the advantage of the ETFs is because they're a standard instrument, anybody can quote, arbitragers and other market makers will come inside and arbitrage that effectively down to the minimum that it can be for you. So you retain that liquidity. I don't think there's a price discovery issue if you have a good footprint. I mean, Dolfin has a pretty good footprint in this ourselves, and you can get out there. But you're exactly right. Sometimes, if all people are the same way, it does cause a little bit of sway on the pricing.
Well, as long as we're on the subject of liquidity and how the ETF market functions, I have to mention USO and what's happened over the past week. So oil is obviously a subject that's near and dear to my heart, but I'd love your take. Maybe we'll ask Carl first, and then we'll ask Geoff to maybe comment a little bit on the oil high yield space. But I'd love to hear what you guys think about the recent events in USO and how that might be replicated or not replicated in bond ETFs.
If I'll go first, Geoff, I was going to say I'm a bit like you, James. Oil is very close to my heart. Really, really interesting topic, and it's very, very. People spend careers in this world and know every detail. The seasonality of the oil is something that's very unusual. So that is only, all those different months that USO was one of the big funds. They were very, very specific on what they do. And as such, oil traders across the world tracked it because they knew when they were going to be trading the different months or rolling a position and so on. I think in the space of WTI, which is physically delivered, that's even more complicated, and that has certainly had extreme moves. And what we're seeing is people adjusting their makeup of their ETF and their funds when it comes to oil to try and give a more balanced approach, effectively not make themselves forced sellers when the world is very, very negative.
Okay, so
the same is true.
Let's just clarify here. So the issue for those who haven't been following what's been going on with USO, the issue here is that the contract is a physically delivered contract. WTI is an agreement between a buyer and a seller, which says that if you happen to be holding that contract after expiry, then you will take for each contract 1,000 barrels of crude oil, and it will be in Cushing, Oklahoma. Now, if there's a place to put the crude in Cushing, fine, no problem. If there's a way to get the crude out of Cushing, again, fine, no problem. But with the collapse in demand and the slow cutback in supply, Cushing looks like it's going to hit tank tops, and all the pipeline has been filled outgoing. So whoever was left holding those contracts into expiry was suddenly stuck with a problem of having something which was not storable, not movable, and toxic waste if they didn't have anything else they could do with it. So there's this physical aspect that I think people might not have fully taken on when they were getting into their crude oil position. Now, because USO trades WTI futures, it owns the front part of the curve, they got themselves into a very sticky situation where that price actually went negative after USO had finished moving out of the position, but they were part of the problem. You actually had negative prices because of people unable to store or move this crude that they were ready to have delivered. Is this an ETF issue? Is this something which I could see happen in a bond ETF where there's a deliverability issue, or maybe another kind of a structural problem that would cause the ETF to somehow break down in a way that would disrupt my ability to transact?
That's a very good question. That's a very good wrap, actually, of where the oil issue is. And if you relate it to bond ETFs, actually, I think the biggest issue is new issues in supply and liquidity. Again, where it's the
Right.
supply and demand curve. And actually, Geoff touched on it earlier. The supply at the moment is huge in bonds. It's been a bit quiet in March, but actually it's excessive. Lots of bond ETFs have pushed off their rebalance from the end of March to the end of April because of the issues that they were having on liquidity at the end of last month. It was a bit unusual. But actually, for bond ETFs, excess liquidity in the new issue market is okay. It's the reverse that we might need to worry about down the curve, because if all the bond ETFs, amongst other players, are looking to buy paper and the supply dries up, then you might have a situation where basically, everybody's chasing the same piece of paper, and suddenly you veer off course, which is you want to invest in a bond ETF to earn a little bit of yield as you go along. That doesn't work if 10 buyers are chasing one piece of corporate paper.
Interesting.
To contextualize that, the strength of the supply, it's not just one investor chasing after that paper. Just to take the European investment grade market, for example, we saw an average of 6 times the subscription for each deal. And new issue premium, that's the premium that an investor demands for taking on more debt from the same issuer, collapsed from 50 basis points at the beginning of the month to what's close to the 5 basis points now, which is what we would regard as a normal market. And as it pertains to bond ETFs, since it's a form of index investing, it's important to understand the underlying constituent bonds sector and the composition as well. So just to give a very brief history of the debt capital markets, look, funding opportunities flow towards growth opportunities. You've had the likes of telecoms companies, they've been pushing out 2G, 3G, 4G upgrades. You've got the US shale expansion as well. And far more recently, you've also had the Chinese home builders, the property developers, also rapidly push out emerging market hard currency debt in order to finance their operations. And these are all nuances within European, emerging market, and US markets as well. For example, US has a much higher concentration of oil and gas names. In the European markets, you've had the hybrid market's been established. That's hybrid bonds which exhibit characteristics of equity, but because they're perpetual in nature, but because they pay a coupon as well, they're still regarded as a bond. That's mostly been a European story where the utility companies and the telecom players in Europe have established that market and have built a reputation within that area. But it's still a recent phenomenon, really, within the US, where it's still being built out by some of the pipeline companies. So as a broad-based investor, the approach has always, it's never been more important to understand the changing and evolving underlying composition of the sectors and the underlying constituent bonds within those indexes as well. And that's what we've been doing. We've been tracking the changes, and now with this surge in FallenAngels into the high yield space, we expect a shift in quality as well, as you've got the likes of Ford, Occidental Petroleum falling into the high yield markets. But with this energy default cycle, some of those some of those junk triple C energy bonds are likely to be pushed out. So I expect a migration in quality as well. So the composite rating of US high yield is currently B+. I think it will shift higher. So some of those investors that, a bit jittery about investing in those single B names may actually come to the US high yield market soon and take a broad-based approach to it and actually.
Right. You've opened Pandora's box, Geoff. So you and I had a conversation along with our colleague Adrian Vandenbach a couple weeks ago. We were talking about the Fed and what they've done in the high yield space. You've mentioned companies falling from one rating bracket into another, from one grade into another. And the Fed specifically was targeting FallenAngels. So let's take that one on. Can you catch me up on what's been happening with these FallenAngels, and can you give me some insight as to how that might affect bond ETFs?
Yeah, so absolutely. We've already seen a very strong rebound in the investment grade market, particularly with triple Bs, where that delta between spreads between single A and triple B rated bonds has already been converging already. But I think what's important as well through the use of ETFs by the Fed is that the Fed understands that ETFs are used as a proxy for index investors. And what it does is it allows, with the liquidity benefits that Carl has already touched on, is that it provides instantaneous relief to the markets on a non-issuer specific basis. We wrote in a note to our investors recently where I paraphrased George Orwell, and I said that all fallen angels are equal, but some are more equal than others. And this arises from some belief that the timing and the criteria of the eligibility criteria of the corporate credit facility, it seemed as though it favored fraud in some ways. And we understand the strategic importance of jobs and the technology and the automotive industry.
Sorry, just have to interrupt. Are you saying that the whole policy was designed around a single name? I mean, that's
timing. It came on the cutoff date for FallenAngels was the 22nd of March, and it seemed as Kraft Heinz bonds are not eligible, Occidental Petroleum bonds aren't eligible, but Ford is, and GM will be, should that be, or if and when that is downgraded. So we saw an element of bias, and this approach that the Fed is taking, adopting ETFs rather than just going down the route of buying underlying single name bonds, removes some of that. And I think the Fed needs to be agnostic in order to not appear biased.
I think that's a very fair point. In full disclosure, I started my professional career at Ford Motor Company. So, I have a lot of love for the firm, but I think your point is extremely well taken. I got to ask though, has the Fed actually been buying any names? Have they actually written a check and bought any bond ETFs, or is it just the promise that if necessary, the Fed will be in there buying FallenAngels or buying bond ETFs, high yield ETFs, that is helping the market to regain some of its footing?
I think that the pledge in itself has already sent a very strong and positive message to the markets and already sent spreads tighter. But what we'd like to see is that the Fed actually reflects what the ECB does and actually discloses every single bond that it does buy on a weekly or a monthly basis. And just turning to the ECB, it's announcing today whether it will introduce any additional measures to its existing emergency pandemic purchase program. Now, we think that ECB chief, Christine Lagarde, she's been persistently urging state heads to do more to tackle the crisis from a fiscal approach. And I think she, in addition to investors, already recognized the diminishing returns of the ECB's monetary toolkit. So I think it will be a last resort for her to echo and copycat what the Fed is doing in purchasing fallen angel bonds. But push comes to shove, in order to protect the recovery, protect the Eurozone and the economic recovery, I think she may be backed into that corner along with the rest of the governing council in order to make that decision.
Carl, I mean, that's big. I mean, if we have the Fed followed by the ECB into the fallen angel space, and and I'm sorry, I just have to throw this out there, but isn't a fallen angel the same thing as a demon or a devil? It's sort of a curious sort of language that we've picked up here. Do you think the ECB's going to follow suit, following on what Geoff was just saying?
Well, I think they are actually, and Geoff was picking up a very good point. They're very open and honest to the ECB. Actually, the Japanese government has been buying ETFs for many, many years and publicizing it and saying it. And as Geoff said, the Fed is sort of saying that it's going to be doing it because it does allow a bit of dribble down in a very easy manner. So I think the ECB might get out there and get involved. I'm not quite sure how, because they have to square it with so many different states, at the same countries at the same time. But yeah, I see them doing it. And the only thing I would say is looking at the ETF reports, where on a daily basis we have a little look at the flow and what the trading action is. I've never seen so many fallen angel linked ETFs been mentioned for 5 million clip traded here, 10 million there, 8 million there. I just had a look this morning, and again, the top of the list are some of these fallen angel ETFs where people are obviously active and interested. And that's quite contrary to where we were 6 months ago, where it was almost always exclusively some sort of IG index linked product.
So the ETFs have helped people to more aggressively trade around sort of a Fed backstop for this kind of intermediate, not quite high yield, not quite investment grade, but fallen angel. So it sort of sits in the middle. Would you say that's fair?
Exactly. I think that's very fair. And I think also people have to understand ETFs are not just tools for retail, they're also tools for institutional. So these flows that you can see, and they're printed on all the exchanges, they're very visible. This is people out there maybe hedging their positions, looking after their positions. And as a sort of smaller user, as a retail person, it's great because you get to roll along with that as well and get some institutional pricing. So it's a really good bellwether on what the world is doing and what the markets are doing and what the individuals are doing out there, whether you're a retail person or whether you're an institutional trader or so. Hedging your positions with ETFs is now the go-to position for many desks across asset classes, and we touched on oil as well, and this is exactly the same. You're getting the best you can out of the world, and the ECB I think has sort of seen this as well, in the sense that they can encourage people down that route themselves, maybe by participating.
Interesting. So what are the trends that we see in months and years to come in the ETF space, particularly in the bond ETF space? How do you see this market continuing to evolve? Geoff, what do you think?
So the ETF market is rapidly expanding. As of my last count, there's some $5 trillion in assets. This is including equities, which is the largest, but the fastest growing area is in bond ETFs, which is currently standing at 1.1 trillion. And just as we've seen, there have been various offshoots of the major equity indices, which has allowed investors to play on different sizes of capitalization, thematics, dividend income, and we've really seen creation of niche segments as they've been adopted to meet client needs. And we expect that to be replicated in the fixed income world, where we already have convertible bond ETFs, municipal bond ETFs, emerging market debt, that's really growing as an area. And we could expect more reverse inquiries and segregated and tailored ETFs, again, to address client demand. But the one that we really think will take off and that we're focusing on ourselves is the megatrend ETFs, where you can play on, say, tech disruption, climate change, shifts in wealth and demographics, and let's say infrastructure development as well. And I think that will really push the space further to where the ETF universe actually takes on an even more sizable part of total assets under management.
So this is a lot like the sort of the thematic and the style baskets that you'll find in various equity ETFs out there. That in some ways it helps sort of retail investors to start to replicate, at least in part, some of the strategic options that are available to more sophisticated hedge fund type operators. And if this expands into the bond space, then presumably you've just got a lot more opportunity for investors to tailor a position.
That's absolutely. But As Carl had mentioned, in order to reap the liquidity and the volume benefits of these ETFs, one must actually use this ETF in size. But what we're seeing is that some areas still require active management and value-added analysis. One of these areas that we've seen, significant take-up in is in the impact investing universe. We've already seen a great deal of analysis towards environmental factors and corporate governance factors, but increasingly we're seeing investors and clients and corporates more and more interested in the social implications of their investments. And now last year we had Enel, the Italian utility, they issued the inaugural SDG bond. That's a bond that's aligned with the UN's 17 Sustainable Development Goals. And we think that could begin to pick up and really overshadow the existing green bond market. Now, we've already got ESG ETFs and green bond ETFs out there, and I don't think we're very far away from seeing an SDG ETF either. But for now, I think it requires active management in the space. And just to segue briefly, we've hired a impact investment analyst, Annie Giovanni at Dolfin, and she'll be launching Dolfin's private opportunities in this particular area very soon, where the portfolio not only meets the objectives of the client from a financial return perspective, but there's also a measurable social return attached to that. And she'll be speaking more in depth on this subject in one of our upcoming Beyond Coronavirus webinars.
That's right. Thank you very much for reminding us about that. So Carl, tell me then how Dolfin takes advantage of ETFs. Like how do bond ETFs fit into the way Dolfin is executing its fixed income strategy?
That's a great question, James. Actually, it quite links on a little bit to Geoff. If I just add a little bit more to what Geoff was saying there, we talked a little bit about new ETFs or where the market is going. The opportunities in bond ETFs for more actively managed ETFs is huge compared to equities. Everybody talked about equities being very much more active management and niche is the next best thing. But in reality, they're fairly, the majority of run of the mill. Whereas in the bond world, you've got great opportunity. Geoff touched on it, green, ESG, any different thing that might come along. I think you've got a good facility to sort of use it as a platform to offer to clients and offer to a broader range of clients. So that comes quite back nicely to Dolfin. How does Dolfin use ETFs? You can use ETFs to access certain areas that we want to access very quickly. Perhaps we don't have the core expertise in that particular segment or market. Perhaps we don't have enough time at that second in time to evaluate every region, but we can gain access very, very quickly in an institutional level with institutional pricing, as Geoff said, and also be quite defined and quite precise. So we have clients with a variety of different sizes on their accounts. We can ensure through an ETF that they can all gain in that particular viewpoint of our investment management team, along with the fact that, let's face it, if there's an ETF that comes out that's really focused on Australian bonds, and that's an area we want to get involved in, then it might be easier for us to access that rather than sending orders overnight to Australia to buy a few bonds here and there. We can do both, but to me, the ETF sounds a little bit more like an intelligent management solution.
Yeah, I think I guess it gives us sort of the ability to leverage some of the scale advantages, the economies of scale that that extremely large firms might have. So we can remain nimble on the one hand, and yet still be able to take advantage of scale at the same time. And so the ETFs kind of help us to become sort of a tool in our toolbox that let us get to that kind of a position. Fantastic, guys.
Exactly, it's a fantastic.
Sorry?
I was going to say it's a fantastic tool for us, because the best thing is when we go and want to buy or sell a little bit of ETF, we can get a load of players to compete on price for us. So not is it just getting the execution, but we talked about it with Simon before. It's about earning those extra few basis points by getting the best price we can for the clients.
That's right. So liquidity, narrow spreads, being able to operate at sort of the time and place of our choosing. Yeah, it sounds like a really useful tool. Geoff, Carl, thank you so much. Is there anything that I've missed that you guys really were just sort of burning to bring up?
No, I've enjoyed the conversation. I think I'll see a lot more ETFs in future, and I'm sure we'll all look at the headlines a bit more.
I don't know. Well, on behalf of investment management, Carl, I think I can promise you that you will be seeing a lot more ETFs in the future. Geoff, any final comments?
Yeah, so we've employed and we've actually used ETFs in the past when there was low dispersion of returns and less opportunity to actually capture alpha. But we've actually seen that a broad-based approach to investing may not necessarily work in every single market right now, because you've seen, at least we expect increased variance of investment performance, because you've got some directly impacted sectors such as airlines, leisure, hotels, casinos, energy. So in addition to using ETFs, at Dolfin, we're going to also take a single name approach, where we're building two baskets currently. One is a basket of resilient names, which we expect to, or have already exhibited outperformance in the recent sell-off. And our conviction is that they will continue to be insulated if there are potential second and third order effects of the current recession. Some of these include the utilities, telecoms, and technology sector. And we're also building a recovery basket as well of single name bonds, where we think there's some dislocated opportunities where names have been dragged by their peer group and they're currently undervalued. These lean more towards the high yield segment, but we think that prudent sector allocation, security selection, and understanding covenant packages and building out fundamental analysis of single names will also be incredibly useful in trying to navigate the current market environment as well.
So I think it's really helpful that you did remind us about the resilience in the recovery baskets, because on the allocation side and the investment side, that would be a much more difficult strategy to deploy if we also couldn't rely upon ETFs to give us some variation of beta that we could also have as part of the portfolio. So the fact that the ETFs are a relatively clean and simple and accurate way of pinpointing the parts of the beta that we want to pull into the portfolio allows us to then refocus a lot of our resource on the single names that we think make clear sense given a certain kind of environment that we're in, the recovery and the resilient baskets being characteristic, very, very good examples. So I think it's a really good point. I mean, weirdly, the existence of the ETF enables our ability to take advantage of what we think is going to be an increased dispersion in both equities and bonds, and to try and look for alpha in single names. It's funny how those two pieces kind of reinforce each other. So, hey, look, guys, I think we're running a little bit tight on time. This has been very, very helpful. Thank you very much. I appreciate your both taking the time to walk us through what's been going on in the bond market, and particularly in bond ETFs. Geoff Wan, my colleague in investment management, Carl Androsiuk, my colleague in the trading side. Obviously, my name is James Gutman, and I wanted to thank our clients and our guests for watching. I'd like to remind you that we have other videos that we have that we've done recently. In particular, we've done one in our Beyond Coronavirus series on video games. It's not just for nerds anymore. And we have another one coming up in very soon in the Beyond Coronavirus series on retail in e-commerce world, which seems extremely topical given the sort of the changing consumption patterns that we've all been living. I will also be having a follow-up conversation next week with Andrew Dodson, who's a managing partner at Phillip Advisors. We spoke last week about the extreme moves in the oil market, and we'll be having another conversation next week to fill in the gaps and to catch us up a little bit as those moves in crude oil have been quite dramatic and are not are not dying down yet. So lots of video to keep an eye out for. And I want to thank you again for your attention. If you have any questions or if you need any further information, you can please visit us at dolfin.com/research, or you could email me directly, james.gutman@dolfin.com. Thank you.